As of 9:34 a.m. Eastern Time, Nuburu Inc., ticker symbol BURU, is trading on the NYSE American at 0.2562. That is a sharp drop of over 22.9%, down $0.0765 on the session. The stock opened at 0.26 and has so far traded in a tight, downward trending range between 0.265 and its current low of 0.256. This move is happening on significant volume, with over 3.6 million shares already changing hands, which is a considerable amount for a company with a market capitalization of only around $35 million. And right away, what's critical to understand is that the number you see on the screen, this $0.25 stock, is not trading based on the story you think you know. Most retail investors, perhaps looking for online investment opportunities on their Robinhood app or SoFi Invest platform, might see Nuburu and find a simple, compelling narrative. A high-tech company that makes unique blue lasers for welding and 3D printing. This is the expectation. The reality, however, is one of the most complex, high-risk, and dramatic corporate transformations you will find on the public markets today. What's happening with BURU has very little to do with its original laser business and everything to do with a last-ditch pivot into a completely different industry funded by staggering shareholder dilution. The common belief, the story that got Nuburu public, was that its patented blue laser technology was a superior tool for materials processing, especially for welding copper, which is critical for electric vehicle batteries and other electronics. The expectation was that this would be a picks and shovels play on the EV and advanced manufacturing boom, perhaps not to the scale of Tesla stock or Nvidia stock, but a key component supplier nonetheless. Investors were betting on a technology, but the financial reality of that business, as we can see from the filings, was brutal. The company has been burning through cash at an alarming rate. As of its last major report, the company had a staggering accumulated deficit, total liabilities of over $47 million, dwarfing total assets of just $2.4 million, and a dangerously low cash balance of just over $100,000. This led to a formal going concern warning, which is an auditor's way of saying the company might not have enough to keep the lights on. This is where the story truly changes. The reality is that Nuburu is no longer just a laser company. It is now under a new dual CEO and executive chairman, Alessandro Zamboni, attempting to become a diversified defense technology and software as a service or SaaS platform. This isn't an evolution, it's a complete corporate rewrite. This shift is being executed through a rapid series of acquisitions and joint ventures. First, they announced a joint venture with Maddox Defense to get into drone technologies. Then, and this is the core of the new strategy, is Nuburu is in the process of acquiring Orbit SRL, an Italian SaaS company focused on operational resilience and crisis response. They are also simultaneously looking to acquire another different blue laser business, not to double down on their own tech, but to acquire that company's engineers, facilities, and existing customer base. This is an attempt to buy a functioning business while bolting on a new unrelated software and defense arm. This entire transformation is what's driving the stock's volatility. The recent daily swings and massive volume, with an average 90-day volume near 100 million shares, are not from investors calmly buying and selling lasers. This is the sign of a stock in play, with traders and speculators trying to front-run news about financing, acquisitions, or, frankly, its survival. The stock is currently trading near its 52-week low of 12 cents, a far cry from its high of 99 cents. This isn't the kind of stock you park in your Schwab Intelligent portfolios or a broad Fidelity mutual fund. This is a high-velocity speculative trading vehicle. The risk profile is off the charts, which is why institutional ownership is almost non-existent, at less than 1%. Compare that to Apple stock, which is a staple of Fidelity Wealth Management and nearly every pension fund. Here, the ownership is 94.3% general public, meaning it's almost entirely retail investors and traders holding the bag, many of whom are likely using platforms like Robinhood stock trading to make these high-risk bets. This brings up a key point about self-investing. A basic individual brokerage account at Fidelity or a sleek SoFi trading platform gives you access to buy the stock, but it doesn't convey the profound risks buried in the filings. The most significant reality here is the cost of this transformation. To fund these acquisitions, the company has been issuing stock at a furious pace. In the last year, total shares outstanding grew by an almost unbelievable 1,793.6%. That is massive, crippling dilution. Every new share issued to fund these deals makes each existing share worth less and less of the company. It's a race against time. Can the new management get these acquisitions done, integrate them, and, most importantly, start generating revenue before the company's cash reserves run out completely? The company itself stated it anticipates its first billings from the new defense ventures about $500,000 in the fourth quarter of this year. That is a tiny number compared to its cash burn and liabilities. The complexity is compounded by the nature of these deals. The main acquisition was, according to filings, wholly owned by Nuburu's new executive chairman, Alessandro Zamboni, before the acquisition. This is a related party transaction, which always raises governance questions. While the company states it was reviewed by independent directors and a third-party firm, it adds another layer of complexity to the story that a simple investment site search won't reveal. Even the company's relationship with its exchange has been rocky. It recently received a warning letter from the NYSE American for not providing advance notice of material news, specifically the announcement of its new dual CEO structure. This isn't the kind of headline that inspires confidence from long-term investors or large institutional platforms like Interactive Brokers. So, what is the path forward, and how does all this tie back to the expectation versus reality? The expectation for a sub-$1 stock is often a hopeful binary bet on a turnaround. The reality of Nuburu is that it's one of the most complex turnarounds imaginable. The bull case, if you can call it that, is that this new management team successfully executes a roll-up strategy. They use the public shell of Nuburu to acquire multiple, potentially cash-flowing assets in the high-growth defense and software SaaS space. They are betting that this new combined entity will be far more valuable than the legacy laser business ever was. They hope to build a new company from the ashes of the old one, and they are projecting a multi-billion-dollar market for their new defense software. This is the story they are selling. The bear case is simple and stark. The company is a going concern with negative equity, almost no cash, and massive liabilities. It is funding a complex related party acquisition strategy through extreme shareholder dilution. The risk of total failure, delisting, or bankruptcy is not just a possibility, it is a clear and present danger outlined in their own financial reports. This is a financial tightrope walk, and the stock price you see today reflects that deep uncertainty. Investors looking for investment help or a stable investment will not find it here. This is the deep end of the pool, a space reserved for highly risk-tolerant speculators who have read the SEC filings and understand that they are not betting on blue lasers, they are betting on a complete corporate restructuring against incredible odds. Comment below with your thoughts on this. When you see a stock with this much dilution, does it ever make sense as an investment, or is it purely a speculative trade? As we look at the chart, the stock is struggling to find a floor. This isn't a technical trade based on moving averages like you might see with Nvidia stock. This is a news-driven story. Any press release about financing, a new contract from its drone venture, or a delay in its acquisition closings could send this stock soaring or crashing by 50% in a single day. Trying to manage a position like this requires a robust platform, something more than the basic SoFi ETFs offering. You'd want the real-time data and complex order types offered by Interactive Brokers Trading or the deep research tools available on a Fidelity trading platform. Even then, the extreme volatility could trigger risk management halts, and the liquidity, while high in share volume,